Hi everyone, this is Rob Roy and welcome to the Elliott Wave Options U.S. Market Update. Well, last week we talked about how we were setting up for a potential bounce where we had the equities market as evidenced by the S&P 500 and interest rates both nearing areas of support. And I kind of called it like a Goldilocks scenario because from an Elliott Wave Fibonacci standpoint, it was very classic. The patterns were just textbook from both of those type of scenarios, Elliott Wave and Fibonacci. So we got there, we got the bounce today. So both of those markets came down and hit those Fibonacci areas, found support, we got the bounce today. Now the question becomes, does Goldilocks have legs? How long can the bounce last? Can we go further up from here? Well, what started the bounce last night, even though the market always wants to assign a reason for it, is the fact that Australia cut rates last night for the first time in a long time. And then we had Fed speak, where we had the top two guys, Chairman Powell for one, coming out and saying basically they were ready to do whatever they needed to support the market and the economy. The market loved that. Futures were up and we got the big bounce today. So again, how long can this last? Let's take a look at the charts and find out. So we take a look here at the S&P 500 and we just have Fibonacci Elliott wave everywhere. As I mentioned, we look and see there's the wave 4 that came down to that 38% level. That's what I was talking about, where we're coming down to major Fibonacci support levels. And then we have this zigzag pattern that was located within the wave 4 correction. So a pattern within a pattern, or pattern within a wave. And that's why I like these corrective patterns, the zigzags and triangles specifically. You can clearly see the zigzag pattern here. We highlighted it last week and it went exactly where it was supposed to go. And then you can see the bounce with the big bar to the upside here. So if we draw, kind of mess up the chart and put all these lines on here, there's the 61.8% correction that we noted in the wave B of that zigzag. And again, all of this is located within the wave 4. Then we come down to that 100% extension in yesterday's trade, and then there's the bounce that we got today. So we bounce higher. How far can we go? It's going to be interesting to see. Let's take a look at the chart of TBT for interest rates. And remember, we were talking about interest rates coming down and finding an area of support. So you get the bond market and the equities markets both ripe for a bounce. So we had a 38% Fibonacci correction there in the wave 4. And then here in the wave 5, again, just like the equities market, we have a zigzag pattern in this last leg. So here in the wave 5 down, which that gives, you got to look at the bond market. The bond market's extremely important, and the fact that we have a wave 5 likely completing here on interest rates gives hope that this bounce can actually sustain itself for a little while, that it may have some legs after all. So here was that pattern here where we had the correction, 50% correction in this case, and then we get the 100% extension. You can see we came down, actually broke below it a little bit yesterday, and then we came back up to it. So we're finding support right there at that 100% Fibonacci extension in the wave 5 of interest rates. So this charts couldn't be any more Elliott Wave Fibonacci setup. In fact, if you watched CNBC today, Rick Santelli actually went through and talked about the Fibonacci sequence and how it's applying in the bond market as well with interest rates. It was pretty interesting. So you might catch that on YouTube or something to see him talking about it. But it's everything that we're teaching you here, and so it's good to see that other people realize the importance and power of Elliott Wave and Fibonacci sequencing. So pretty classic stuff. How far can we bounce? Well, if we take a look at the VIX, because you need energy, right? You need some volatility in the market. In other words, my point is, if the VIX was way down here in this area that we were back in 2017, if you're sitting there with a VIX down around 8 or 9, that's not a lot of momentum left for an upward move, because as the market goes up, we know volatility comes down. So we need a little juice in the market, if you will. We need a little volatility there. And even though the VIX dropped today, obviously, it's still fairly high. It's still around 17. So that's enough. in order to give us a bit of a further bounce in the market. That's enough energy, if you will, in order to sustain the bounce just a little bit further. So where could a likely target be? Well, the first target that we would look at would be a rebound of this zigzag pattern. So what normally happens when you complete a pattern is it will retrace the last impulse move. So in this case, the wave 4 is the impulse move. We had this zigzag within it, but that was the impulse move. So we should or could go back towards that wave 3 high, and barring any odd news, we do have the news-driven market, but again, last night, Australia cut rates. That was a catalyst. Futures were up on that news. Then we had Chairman Powell, and we were off to the races, as I mentioned earlier. So barring anything unusual to derail that, or the Fed coming out and saying, we were just kidding, we're not going to cut rates if needed, but the Fed fund futures are already pricing in a high probability of a rate cut. Some percentage, believe it or not, at the June meeting. Not enough for anybody to take it seriously, but it shows you that probably before the summer's out, we could very well be looking at another Fed rate cut, which is fascinating. And a lot of people disagree with that. They think the Fed's listening to the market too much, and that's not the Fed's job. But they kind of seem to be, honestly. But the 38% correction there in the big overall wave 5 pattern, we could see as much of as a 61.8% extension in the wave 5, which takes you right to the already forecast target. So again, barring anything unusual, that's a possibility. But first of all, we retrace the previous impulse move, and we'll see if that plays out. Now, this could be a short-term bounce, and one of the reasons that we have to be careful of that is there wasn't a ton of volume today. If you look down at the bottom of the chart, you can see wasn't huge volume, but it wasn't horrible either. It was almost average volume, which on an up day is pretty good. Because what happens quite often when you start an upward impulse move, it starts on low volume. People aren't really sure that upward move is going to happen. You start with some short covering, which no doubt is what was going on today. And then the buyers start to come in after the shorts have covered, and they give that impulse a little bit of a bump, a little bit of a start there, and then some of the buying comes in afterwards. So to have almost average volume, it's not horrible. So it wasn't great, wasn't horrible. It could certainly be enough to jumpstart a further upward move. So again, question becomes, does Goldilocks have legs? We'll find out, but the potential is certainly there with the charts. Last thing that I wanted to talk about is, remember, the 38% level is a Fibonacci level. It's a strong Fibonacci level, so it could just be short-term support. And then we go down further to a 50% or 61.8% wave 4 correction. But at this point in time, it looks like things are set up that the market, if left alone with no unusual news events, could be left to bounce higher, especially with the Fed. They call it the Fed put, meaning that the Federal Reserve basically committing to do whatever they need to keep the market moving, keeps kind of a floor under the market. So that's what we'll be watching for this next week. Hope you've had a wonderful week, and we'll be back to talk to you again next week. Take care, everybody.